In this lecture, I would like to say something about the fundamental ideas that is very necessary for maintaining the sustainability of an economy. Very recent time, we have and data-based information that RBI released on few days ago that the asset creation by the household is slower than the increasing in liabilities. You know, the household is important factor for an economy because whatever is floating on the surface of the human mind that actually manifest in the economy. So each and every household's understanding of financial knowledge and their education is very, very important for the sustainability of the economy. You know that households, we have found the information that piling more liabilities in compared to asset creations. It means that the liabilities is growing faster than the asset creation by the household. If I compare two periods, that is before the pandemic, 2019-20, and recent years, that is 2024-25, then we find a very huge transformation here. Asset creation has increased just 48%, where the liabilities has increased more than 102%. You know, here is another information on the database that household investment in mutual funds has increased over 655% in compared to the 2019-20. So on that basis, what we understand, here is a problem because there is another information I could mention here. Deposit by the household in the banks is mostly stagnant during this period, that is 2019-20 to 2024-25. So households' investment in the mutual fund or financial assets rather than the bank deposits, or you can say in that way that from where the interest rates are low, people are shifting from that section to that section where returns is very high. So this thing has some impact on asset creation. You know, the investment in the stock market is not the investment in that sense. People should balance between consumption, savings, and investment, not on the basis of the credit or borrowing, but from the productive point of view. Nowadays, people are getting credit from the bank and investing in the stock market or mutual funds. That is very risky and vulnerable. It is very fragile, you know. So this thing hampering the asset creation because people are investing in the securities that are already floating in the secondary market. Money is transforming from one pocket to another, but there is no asset creation. If people invest their money in banks or post office, where they have the small interest rate in compared to the return from the mutual funds or stocks, that assets actually used for the productive purposes, for creating the infrastructure, for increasing the farms, periphery, and other productive lineup. So these are hampering, and this is not the fundamental base for maintaining the sustainability of an economy. In the long run, if such type of information that RBI has released, then the economic fundamental base will be very weak, and in the long run there will not be a sustainable situation. So there are some economic theories, the theories of Modigliani and theories of Keynes, and these theories actually do not maintain here in that sense. In the Modigliani, you have some information that people at the young age, they mostly get involved in credit or debt, and when they are in service, they save, and at their old age they actually expend their savings. This is the Modigliani's theoretical understanding. But in India, this theory does not hold nowadays. If you consider the Keynesian understanding, then also you find that there is not a proportional relationship between the consumption and income. And as there is no proportional relationship, some money goes to savings account. But what actually is happening nowadays is that the people is spending more and more over their income. And not only they are spending in non-performing assets. They are investing in stock markets. So there is a lack in the asset creation, and it is very crucial. Financial assets added each year fell from 12% of GDP to 10.8% of GDP in 2024-25, and liabilities, on the other hand, rose from 3.9% of GDP to 4.7% of GDP in 2024-25. So even as the economy recovered from COVID-19, Indian household did not become more secure. Rather, they became more leveraged. As I have mentioned, that mutual funds saw explosive growth from 65,686 crore in 2019-20 to 4.7 lakh crore in 2024-25. There is a jump 655%. Their share in household financial asset rose from 2.6% in 2019-20 to 13.1% in 2024-25. People are moving away from safe, low return deposit to market-linked volatile deposits because deposit interest rates are lower than inflation rate, while return from mutual funds is much more. This means that the risks has shifted from bank to the individual. If there is a hit or markets fall, then households' wealth takes a direct hit. Rising household debt actually represents rising vulnerability. Individuals' debt is at 4.7% of GDP, which is small, but the point is here that the growth rate of debt is 102%. This is the very crucial signal. People are borrowing to survive inflation and lifestyle cost. If households' repayment capacity weakens, then it could translate later into higher non-performing assets such as personal loans, credit card, consumer finances. So, for correcting these imbalances, whatever I have mentioned here, policymakers should focus on enhancing financial literacy, encouraging long-term savings instrument, ensuring higher real wages with productivity and monetary stability. So, if the financial innovation is not maintained with the financial discipline, then there will be asset bubbles in the economy. So, as I have mentioned that household mind is very crucial for maintaining the economic sustainability. Each and every household should be cautious in such a manner that whether they are creating real assets, productive assets, or just they are running after the return. So, to maintain the sustainable growth, household must maintain a balance between consumption, savings and investment, not by credit, but also by real wealth creation.